Just a few days ago, China's securities regulator did something that sent a shockwave through Wall Street, more powerful than any tariff announcement, any diplomatic insult, any midnight social media post Donald Trump has fired off in the past year. The China Securities Regulatory Commission, working in coordination with 7 other government agencies, ordered the 3 brokerage platforms through which roughly 100 million Chinese citizens access American stocks to wind down their entire mainland operation. Futu Holdings, Tiger Brokers, Longbridge Securities. The names will mean nothing to most viewers. The numbers will. Combined fines and asset forfeitures of approximately 2.3 billion yuan, around $300 million US dollars. Mainland client assets of nearly 37 billion US dollars. All of it now forced into an orderly exit. And here is the part almost no major North American outlet has properly explained. During the 2-year wind down, those platforms cannot accept a single new buy order from a Chinese citizen. They cannot accept a single new deposit. The only transaction permitted is a sell. China did not ban its people from owning American stocks. It did something far more elegant. It left the door open, but only in one direction, out. And on the same week the world was watching this happen, a separate signal was flashing from Ottawa that almost nobody connected to the same story. Most coverage is treating these as unrelated events. They are not. Over the next few minutes, I am going to show you exactly how they fit together and why the timing should worry Washington far more than it currently appears to. Here is what actually happened. On May 22nd of this year, the China Securities Regulatory Commission, known as the CSRC, issued what regulators in Beijing called administrative penalty pre-notification letters against 3 of the most successful cross-border brokerages in Asia. Futu Securities International based in Hong Kong, Tiger Brokers Incorporated in New Zealand, and Longbridge Securities also based in Hong Kong. These 3 platforms had spent the better part of a decade quietly becoming the primary route through which Chinese retail investors purchased American and Hong Kong shares. They built sleek mobile applications. They offered Chinese language interfaces. They handled the foreign exchange conversions that turned yuan into dollars and dollars back into yuan. And they did it all without proper authorization from Chinese regulators. That is the technical violation. That is the official framing. The operational reality tells a different story. Beijing had known about these platforms for years. The CSRC formally declared their activities illegal back in December of 2022. Tiger and Futu were quietly told to stop onboarding new mainland clients. And for the next 3.5 years, very little happened. The platforms continued operating. Chinese investors continued opening accounts. Capital continued flowing from Shanghai into New York. The status quo held until it did not. The crackdown announced last week was not handled by a single regulator. It was issued jointly by 8 Chinese government bodies, including the Ministry of Industry and Information Technology, the Ministry of Public Security, and the People's Bank of China. That is not a regulatory footnote. That is the entire Chinese state moving in unison. The combined enforcement package included a 2.3 billion yuan penalty, the confiscation of what regulators called illegal gains, and the establishment of a 2-year rectification period, during which every single mainland account must be closed. Futu Holdings alone was hit with 1.85 billion yuan in forfeitures. Tiger Brokers 410 million yuan. The market reaction was immediate. Futu's U.S.-listed shares closed down 27.5% in a single day. Tiger lost 25%. Bloomberg reported that Chinese investors were rushing to liquidate before closed entirely. One investor said he sold his entire American stock portfolio on Friday morning. The Hong Kong-based publication Vision Times described the announcement as the closure of the last route through which Chinese retail money could reach foreign equities. Think about what that phrase means in practice. The last route, not the largest, not the most popular. The last one. Beijing has spent years systematically closing the smaller channels. The big institutional routes were tightened. The shell company structures were dismantled. And now, with this announcement, the final pathway has been sealed. China sits on approximately $50 trillion in household deposits, one of the largest pools of private savings in human history. For years, a meaningful slice of that pool was finding its way into American assets through these brokerage platforms. From this week forward, that pipeline is being drained, not destroyed, not banned, drained slowly, methodically, in one direction only. And the money that was flowing to Wall Street will now flow to Shanghai, to Shenzhen, to Chinese government bonds, to Chinese infrastructure investment trusts, and increasingly to the financial partners that Beijing has cultivated outside the dollar system. Now hold all of that against what Ottawa did just 4 months before any of this enforcement was announced, because the timing matters more than almost anyone has noticed. In mid-January of this year, Prime Minister Mark Carney flew to Beijing on what became the first official visit by a Canadian Prime Minister to China since 2017. Think about that gap. 9 years of frozen relations, the Meng Wanzhou arrest, the retaliatory detention of the two Michaels, the canola dispute, the steel tariffs, the electric vehicle trade war that erupted in October of 2024. 9 years of accumulated grievance, hostility, and economic confrontation. And then, suddenly, a 4-day state visit in which Carney met Xi Jinping, Premier Li Qiang, and the chairman of China's Standing Committee, Zhao Leiji. The headline outcome was a so-called landmark trade agreement. China agreed to reduce its tariffs on Canadian canola seed from approximately 84% down to around 15% by March 1st of this year. Canada agreed to import 49,000 Chinese electric vehicles annually at a preferential tariff of 6.1% down from the 100% rate Canada had imposed in October of 2024. Visa-free travel was announced for Canadians visiting China. The canola meal, lobster, crab, and pea industries were promised relief from retaliatory tariffs. These are the items that filled the front pages. These are the items every wire service led with. But buried inside the joint statement issued by both governments on January 16th was a paragraph that received almost no coverage at all. It read, "Leaders welcome the signing of the third agreement to extend and amend the Chinese Yuan and Canadian dollar bilateral currency swap arrangement between the People's Bank of China and the Bank of Canada." Now, I understand that sentence does not exactly leap off the page, so let me translate what it actually means in practice. The People's Bank of China and the Bank of Canada renewed an arrangement that allows the two central banks to exchange Chinese yuan and Canadian dollars directly with each other without using the US dollar as an intermediary. The size of that swap line was set at 200 billion yuan, the equivalent of roughly 28.5 billion American dollars. The agreement is valid for 5 years with an option to extend. That is not a trade deal. That is a financial infrastructure agreement. It is the kind of arrangement that quietly determines decades in advance how money will flow between two economies and which currencies will mediate that flow. And it was signed in a week when the rest of the Western press was focused entirely on canola and lobsters. The same joint statement also announced the establishment of a new Canada-China financial working group, reporting directly to the co-chairs of what both sides called the Reinvigorated Economic and Financial Strategic Dialogue. Read that carefully. A financial working group, a reinvigorated economic and financial dialogue, a renewed currency swap. None of those phrases describe ordinary trade diplomacy. They describe the architecture through which two countries plan to coordinate financial movements for the next 5 to 10 years. While Trump was threatening tariffs, and Bessent was telling reporters that foreign treasury holdings were nothing to worry about, Carney was sitting across a table in Beijing, signing his name to a document that gives Canada direct Yuan access without needing American dollars as a bridge. Many viewers may find that surprising. They should. It received almost no analytical coverage in the Canadian or American press at the time. And here is where the two stories intersect in a way that should genuinely concern anyone in Washington who is paying attention. Beijing is doing two things simultaneously, and they are not separate operations. They are the same operation. The first thing Beijing is doing, as we have just covered, is shutting down every channel through which Chinese capital flows into American markets. The retail brokerages are being closed. The Chinese central bank has reduced its U.S. Treasury holdings to roughly $652 billion, the lowest level since the month Lehman Brothers collapsed. Japan, the largest foreign holder of American debt, shed $47 billion in a single recent month. Total foreign holdings of U.S. Treasuries fell by approximately $240 billion in just 30 days. The 30-year Treasury yield touched 5% earlier this year, the kind of level the United States has not seen sustained in nearly 2 decades. The institutional money is leaving. The sovereign money is leaving. And now the retail money is being forcibly redirected home. Every channel is being narrowed all at once. Treasury Secretary Scott Bessent needs to issue approximately $900 in fresh debt between now and October. He needs buyers. He needs reliable, structural, repeat buyers who show up to every auction regardless of the political weather, and his buyer base is shrinking from every direction at once. The second thing Beijing is doing, which Western coverage has almost entirely missed, is building the alternative system that does not require American capital markets at all. The Chinese cross-border payment system, known as CIPS, processed roughly 1.2 trillion yuan in a single day in April of this year, a record. The yuan has hit a 3-year high against the dollar, up roughly 3% year to date. Chinese government bonds have returned over 1% in gains, even as American long-term bonds have fallen, and Chinese officials have quietly urged domestic banks to reduce their American Treasury holdings further. This is not a confrontation. It is a withdrawal, and withdrawals are far more difficult to counter than confrontations because there is nothing to retaliate against. Nobody is firing, nobody is sanctioning, capital is simply leaving the room. Now think about what that means for Canada specifically. Carney, before becoming Prime Minister, ran the Bank of England. Before that, the Bank of Canada. Before that, Goldman Sachs. This is a man who has spent his entire career inside the global financial system, watching how money actually moves across borders. He understood, almost certainly years ago, that the dollar-based architecture was approaching a moment of stress, and he did something about it. While Trump's administration has been busy threatening tariffs, threatening Greenland, threatening Panama, and threatening Canada itself with annexation rhetoric, Carney quietly renewed Canada's direct currency channel with the country that is now sealing every other channel shut. The United States is being squeezed financially at the same moment that one of its closest neighbors has pre-positioned itself to operate, at least partially, outside the squeeze. Italy, Spain, Germany, the major European economies have not signed direct yuan currency swap renewals on the scale Canada just did. South Korea has its own arrangement, the United Kingdom has its own, but Canada, the country Trump has spent the past year insulting, threatening, and treating as a vassal, is the one that walked into Beijing first, signed the largest North American currency arrangement with China in the past decade, and walked out with a financial working group that the United States does not have, will not have under this administration, and probably could not get if it asked. The standard has changed. The country that prepared for the squeeze is the one that gets to keep its options. The country that pretended the squeeze was not coming is the one now scrambling to issue $900 billion in debt to a shrinking buyer base. Bessent told Yahoo Finance back in April of last year that it was not in China's economic interest to weaponize its treasury holdings because selling treasuries would force China to buy yuan, which would strengthen the yuan, which Beijing supposedly did not want. The math has shifted underneath that argument. The yuan is now at a 3-year high. Beijing appears to be entirely comfortable with a stronger currency, and the assumption that anchored American confidence has quietly stopped being true. What comes next is the question neither government in Washington is yet answering publicly. Bessent has $900 billion to raise by October. The 30-year yield is sitting at levels that suggest the market is already pricing in difficulty. The major foreign holders, China, Japan, the United Kingdom, are all reducing exposure. The retail Chinese capital that informally supported American equity valuations is being ordered home, and the country that should on paper be the United States' most reliable financial partner has just signed a 5-year currency swap with the very country doing the squeezing. None of this guarantees a crisis. None of this guarantees even a particularly dramatic short-term move in markets. What it guarantees is that the structural assumptions that have held American financial dominance in place for 40 years are being tested simultaneously, and Canada has chosen not to be on the side that is being tested. Watch the next Treasury auction calendar carefully. Watch the yield on the 30-year. Watch the yuan-dollar exchange rate, and watch what the new Canada-China Financial Working Group announces at its first meeting later this year. Because the headlines about canola and electric vehicles were the cover story. The currency swap was the actual story, and Beijing did not really fire a shot at America. It just pressed sell. If this is telling you something you have not heard elsewhere, share it. Drop your thoughts in the comments. I want to hear it. Like the video if you want more of this, and I will see you in the next